Richard, I want to bring you into this discussion because obviously, as we've been talking about, there's been a lot of focus on geopolitics this week. We've seen the swings in the market. How do you handle that as somebody who is managing money?
Well, within the framework of a three-tiered analysis of fundamentals, Fed, and geopolitics, the geopolitics is the wild card this year. Obviously, POTUS is going to have a lot of self-inflicted wounds on the market. Yet we have to look back to last April when we had Liberation Day. And as I said, it's self-inflicted, so they'll naturally cure themselves. So what we're doing...
So is this taco by another name? Is what you're talking about? Trump always chickens out, that the market reacts and then he backs off?
I think I think as an investor, we have to look at the other two fundamentals I mentioned, which is the economic landscape, which is very positive, the Fed, which will be very accommodative. And then when we look at this last one, creating the volatility, it's creating buying opportunities as a result of the other two being very positive.
Gotcha. So in other words, you think the fundamental backdrop is positive, and you're not worried that this volatility will spill over into fundamental. It's just going to sort of be surface market volatility?
No, it's very separated and segregated. When we look at the fundamentals, which is declining inflation, a robust economy, we've got excellent jobs. Jobs are moderating but growing, but we've got an excellent backdrop for earnings growth. And we've had 12 quarters of successive earnings growth. I think we continue with that, and as you know, stock prices follow earnings.
Right.
So from that perspective, the landscape is very positive. When we look at the Fed, it's going to be accommodative. Obviously, we're going to have a new Fed chair. So when we combine the fundamentals of the economy, the Fed, and the geopolitical scene, which will be filled with these self-inflicted wounds, they present an opportunity because the backdrop of investing today is very good.
And so where are you looking right now? And has where you're looking changed in 2026 from 2025?
The playbook is about maintaining and then considering some broadening out of the market. So maintaining is our core positions in large cap technology, the AI universe. That trend is really one of the main ones driving the economy. For example, high net worth spending and the AI tailwinds is actually driving economic activity now. So we want to stay with that. We want to avoid the selective capitalism being handed out by POTUS. For example, whether it's credit card companies or institutional home owners.
Right, but how do you know where that's going to land next is the problem. So you avoid it when it happens, but that's by sort of definition being reactive then instead of proactive.
Yeah, I'm not sure I'd be buying those names after they go down.
Right.
But I try to avoid what is a known known. Mm-hmm. Obviously, we don't know what's coming up next. Areas of opportunity on the broadening out theme will be in consumer goods, banks, other areas where they rotate away from the AI and technology trade.
Interesting. So you want to own the AI and technology trade, but at the same time, you want to get into some of those broadening areas. Do they have to be integrating AI, or it's separate entirely from that theme?
Well, I think that's the theme that's going to occur over the next few years, where many industry groups will continue to integrate, embrace, and become more efficient by adopting AI. And the primary outcome will be higher margins, and we'll also see greater efficiencies in their operations. Mm-hmm. So that margin improvement will lead to greater operating cash flow and hence free cash flow. So AI adoption is going to be a long-term process for corporate America, which will ultimately benefit earnings.
Richard, thanks so much for coming in. Appreciate it.
My pleasure.